All right, let's dive into the pretty dramatic story of UnitedHealth Group. This is a real tale of crisis, a potential comeback, and the very clear, calculated path that could see this healthcare giant get back on its feet and maybe even see a stock price north of $400.
And that question, it's really what this is all about, isn't it? I mean, we're talking about a company that looked absolutely invincible, and then suddenly it's brought to its knees by a total perfect storm of crises. This isn't just about numbers on a page. It's about a giant getting knocked flat on its back, and the big question, can it get back up?
So, before we can even talk about a comeback, we've got to understand just how far they fell. Let's take a look at just how bad things really got for UnitedHealth heading into 2025.
You know, it wasn't just one thing. It was everything hitting at once. First, a devastating cyber attack on its Change Healthcare unit just crippled huge parts of the U.S. health system. Then, a truly shocking and tragic loss in its leadership ranks that shook the company to its very core. And right after that, a change at the very top, with the CEO stepping down and a former leader coming back to try and steady a ship that was in total turmoil. And all of this, it ended with a massive cut to their financial forecast for the year.
Now, to really get the financial damage, there's one key number you have to know. It's called the Medical Care Ratio, or MCR. The simplest way to think about it is this. For every dollar you pay in insurance premiums, the MCR is the percentage that gets spent on actual healthcare. And if you're the insurer, you want that number to be as low as possible. And here's the story that number tells. The MCR jumped over 4 percentage points in a single year. I mean, that is just a massive spike in this industry. It means medical costs were running way hotter than anyone planned for. Bottom line, their pricing for the whole year was just plain wrong.
And the result of all that chaos? Well, investor confidence was completely shattered. The company's valuation, its PE multiple, it just collapsed to around 13, which is way below its historical average. The market was basically saying, we're pricing you for trouble, not for a comeback.
But that's where the story starts to turn. A crisis like this also creates the perfect conditions for a big reset. So, with the company on the ropes, what exactly was the detailed plan for a recovery in 2026?
So, this isn't just wishful thinking. The whole comeback thesis is built on 4 very specific drivers. You can think of them as 4 powerful engines that could push the company forward. It starts with fixing the core insurance business, and then really leaning on its other big divisions under the Optum brand.
And, you know, the comeback story gets a huge piece of help right from the get-go, from the outside. Before UnitedHealth even makes its own fixes, the government hands them this 5.06% rate increase for its Medicare plans. This is like getting a huge tailwind that forms the very backbone of the recovery before they even lift a finger.
But of course, no comeback is ever that easy, right? While the company has a pretty clear plan, they're operating in a really tough environment. So now we've got to look at the obstacles, maybe even the villains of the story, the really significant regulatory risks that UnitedHealth is up against. And this, right here, illustrates the core conflict perfectly. On one side, you have this powerful internal recovery plan. But on the other side, you've got that plan running headfirst into a wall of serious government investigations and these unpredictable market headwinds. The winner of this tug-of-war is going to determine the company's fate. And these are not minor issues, not at all. We're talking the Federal Trade Commission and the Department of Justice actively investigating huge parts of the business. The political fallout from that cyber attack is still going on. And there's always the risk that medical costs just, well, stay high. Any one of these could derail the whole comeback. Okay, now for the main event. We've seen the plan, we've seen the risks. So how do all these pieces, the good and the bad, actually translate into a potential stock price? Let's break down the math.
It all starts with something called earnings per share, or EPS. Honestly, the easiest way to think about it is just the raw horsepower of the company's profit engine. More EPS means more power. Simple as that.
And the second part of the equation is the PE multiple. If EPS is the engine's power, the PE tells us how much investors are willing to pay for that power. Are they excited or are they worried? And the formula is beautifully simple. You take the earnings per share, you multiply it by that PE multiple, and that equals the stock price.
Okay, so this table just lays it all out super clearly. Even in a weak or bear scenario, the stock still recovers to about $352. But check out that middle row, the base case. If earnings get back to a solid $24.50 per share and investors give it a slightly better multiple of 16.5, you get an implied share price of $404. That's the path. And of course, a more optimistic bull scenario gets you all the way up towards $459. And hey, on top of all that, there's a little kicker. On top of any potential price increase, investors get paid a dividend yield of nearly 3%. That's a nice extra layer of return, and it's pretty unusual for a company that's historically been seen as more of a growth story.
So, we have the plan, we've crunched the numbers. But what's the final crucial piece of the puzzle? What's the one thing that makes all of this actually happen? What ignites the comeback?
And this right here is maybe the most important takeaway of the whole analysis. Success here doesn't require any heroic, crazy assumptions. The pass back to $400 doesn't need some sky-high valuation. It just needs a return to stable, competent, maybe even kind of boring operational execution.
The author here summed it up perfectly. It's not about being heroic, it's about getting back to the basics. Price your insurance correctly, manage the business steadily, and just execute. If UnitedHealth can simply be itself on a good day, the math suggests that's more than enough. The only question left is, can they do it? Because that execution, that's the final catalyst.